Thank you all for taking time out of your busy schedule to hop on this Life and Annuity Academy webinar series with us. We have some guest speakers, so it's not just going to be me and Bernard talking the whole time. We're going to go over a wide area of topics. So start this off, we're going to have a word from Christy Strauss, our Vice President over here at Insurance Advisors Direct, to talk a little bit about us and what we're looking at this year, followed by the industry outlook on IULs with Chris Schaefer over there at True Choice. Alan Roman will go over some tax updates for 2025 that revolve around the life insurance space. We'll move into Chris Schaefer and F&G talking about the industry outlook on IULs, so what to look forward to. And then at the end, we'll go into some IAD sponsored marketing reimbursement programs we're offering the first quarter for life and annuities, and then our closeout and giveaway. So again, thank you all for attending. And with that, I'll pass it off to Christy Strauss for just a quick word on us and IAD.
Hello, and welcome everyone to today's webinar. It's actually a series today and tomorrow. If we haven't had the chance to meet, my name is Christy Strauss, and I am the Vice President of Sales here at IED. I just want to thank you for taking time to join us. We truly appreciate your commitment and learning and growing with your business. We're thrilled to have some incredible guests with us, as Tyler mentioned, and our dedicated sales team, Tyler and Bernard. They're here to support you in your journey with life and annuity products and offering insights and strategies to help you in your success. So at IAD, our mission is pretty simple. We meet you where you're at. We like to simplify your success and help you grow your business. So we're excited to be part of your journey, and we look forward to partnering with you every step of the way as you begin this journey with your life and annuities. So with that being said, thanks again, and let's just get started.
I'm glad to be here today. And Tyler, Bernard, myself, obviously Christy, we all work together to help grow your business and to help not only grow it, but to help it be easier for you to do business. Okay. What I'm going to do here today is I wanted to talk a little bit about some of the trends that are going on with IUL and in that industry. I don't have slides to show you, so I'm just going to talk a little bit. So you might want to take a second, get a pad of paper and a pen. Some of this information is pretty good. You might want to write it down. When I get done with this, we're then going to move in, and somebody we all work with named Miles is going to have a presentation that he's going to go through on IULs and sort of the iterations that have come and gone. But a few trends coming into 2025 that you might want to understand and know about when it comes to IULs. Okay. Before we do that, though, the overall life business, the life market has been growing and trending up. But when you look at products inside the life market, when it comes to IULs, VULs, term, whole life, things of the such, IULs is one of the fastest grower in there. 2025, they're saying the growth is going to be upwards of 6%. Okay. The growth is going to be driven by increasing demand for the way these products are flexible. That's a big thing in today's world that people want with we live in a world that's everybody's moving, changing jobs, doing things all the time. Flexibility is key, and that's the one thing that IUL brings to you versus some of the older generations of life insurance where it was a little bit more regulated or just strict, right, with what you had to do. So flexibility is a big part of that growth. The other thing that's going to be happening, a lot of the insurers that make these products and put them out there, they're really looking to simplify IUL products. Okay. They're looking to simplify them and the processes to try to make it more accessible or easier to understand for a broader range of consumers. Okay, this is really something that's expected to continue in the coming years with most all the companies that are out there. Another thing that you could see coming in the market is technology. Okay, we all know about AI and big data. We've heard over the years how we've tried to go with accelerated underwriting. Well, artificial intelligence is really something that's transforming underwriting and hopefully making it a little bit easier to where it could do things like eliminate parameds or really limit those more than they're already trying to do. Basically, it's going to enable faster approvals, okay, and eliminate all of that downtime and back and forth that you have with clients through the underwriting process. That's what the hope is. Um, Another thing that's going on is insurers are integrating health and tracking programs into their policies. Okay. One of the big ones with this has been John Hancock. They've been doing it for years. But policyholders, what'll happen with these is they will allow the client to um, show on a daily, weekly, monthly basis through logging into portals or through wearing Fitbits or other sort of trackers that you have, where they can track the steps you're taking and the workouts you're doing to help you lower costs inside a policy, possibly even lower the premium that you need to pay out. Okay. When we start looking at demographic shifts, right? Millennials and Gen Zs are becoming key buyers. This is one of the biggest markets for insurance. Okay, and this is part of what's going on with the overall changing that they're starting to implement in the industry. Is these people really prefer digital first experiences, right? They're more mobile, they move more, and they research stuff more. So they're really trying to get this stuff where the research is able to be easier and able to bring right to their fingertips the information that they want. All right. So some economic and market conditions when we look at that, right? Interest rates. Okay. Interest rates actually are projected to remain elevated in 2025. I know here we've with the administration, they're asking the Fed to lower rates, but I've actually heard some stuff that they really might not do a whole lot of that at this point. Um, but you know what happens with these elevated things to a sense, it does help insurers in a way because the elevated rates help their general bucket of money. It helps their general pool of money get better investment returns, right? They make more money, which helps to stabilize and possibly decrease premium rates. IULs, why IULs in the current market and what's going to be happening is equity markets are expected to remain strong, but could have some more volatility to them, correct? So this is where IULs are going to help. You're going to be able to get that upside market performance and not have to worry about that downside. It's going to really help the cash grow inside those products. All right. And you know, folks, these are things that I always tell you when it comes product specific with stuff like that. You got to make sure to get a hold of Tyler and Bernard, and they'll help you through some of the actual specifics on the different products that are out there that could benefit you and your clients. Okay. Um, there's going to be some, you know, we may face some regulatory changes, okay, that can impact product design and sales practices. It's important to stay up on those. I know later today there's going to be an advanced market person talking, and he might talk about some of those things a little bit. Um, and then another challenge is just privacy concerns with the increased use of AI and big data. Okay. Um, but the bottom line is this: the outlook for universal life in 2025 is positive. Index universal life is looking to be the strongest grower, followed by variable universal life. Okay. These are where they're looking to see the biggest growth this year. Expect some product simplification on some of the new things and technical advancements. So, with all of that, that's kind of a lead in to here. We got a gentleman named Miles Brown that's going to talk a little bit to you now. And Miles, if you're there, you could go ahead and hop on.
Hey,
Thanks,
good
everyone.
morning. Can everyone hear me? All right. I see Tyler shaking his head. So good to go. I appreciate it. And yeah, thanks for inviting me today. And Chris handing things over. Very excited just to spend a little bit of time with everyone. I'm just going through what I have is going to be somewhat of a look back. I know that's not what we want to spend a majority of our time on. From a carrier perspective and regulatory perspective, and then taking a look forward when it comes to product and regulation. I certainly agree with all of the points that Chris just covered there. The outlook in the IUL space is certainly very strong. And I'll also hit on a few of the topics that Chris covered, and maybe a few others as we're rounding things out at the end. But with that, let me go ahead and share my screen here, and then we will go from there and we'll dive right into my presentation. All right. And I will say I've slimmed down this presentation. It is borrowed from F&G's Chief Product Officer, Todd Pettit. He is somewhat, or really is, an IUL guru from a carrier perspective in the industry. He's had a long career in the IUL space, and we're very fortunate to have him over here at F&G. So if you're wanting more of an in-depth look at this from a Chief Product Officer and actuary perspective, feel free to reach out. I'd be happy to share a copy of that recording with all of you. But again, my name is Miles Brown, National Account Manager that supports all of you at AID. So we're IAD, excuse me. So wherever you're located in the United States, I'm going to be your go-to external wholesaler to support you. So I'm happy to help with any questions or cases that you're working on in regards to the products that we offer here at F&G. But right where we're starting out is a timeline of the AG 49 regulation, and I promise to keep this as interesting as possible and not boring. But the AG 49 regulation has really been what has regulated the IUL products in the industry, no matter the carrier. And if we take a look at the timeline here, the NAIC enacted model law number 582 for life insurance regulations in 1995. So from 1995 all the way up until 2015, so what is that, a 20-year period, there were no regulation changes in regards to how IULs or any insurance products can be presented to a client. Well, what do you know? The first IUL product was launched in 1997. So 2 years after a regulation was enacted, the IUL product was released into the market. So as you can imagine, when that 1995 regulation came out, really didn't address anything in regards to indexed universal life products. So we essentially had an 18-year time period where it was somewhat known as the Wild Wild West when it came to IUL illustrations and what we can present to consumers. And throughout this presentation, I'll show you how these regulations have affected how we can show illustrations and present concepts and case designs to clients. But it's really worked in clients' favors because we're able to offer and show them a more realistic version of an illustration that has a better chance of coming to fruition than illustrations that were presented from 1997 to 2015. I do like to point out that F&G launched their first IUL product in 2003. So we've had over 22 years as a carrier in the IUL space. So insurance certainly is not new to F&G. We've been in the insurance space for over 60 years. And of course, 6 years after the first IUL was launched, F&G launched their first IUL as well. And then moving a little bit further to the right here, right, as I mentioned, in 2015, the NAIC adopted the Actuarial Guideline 49, or AG 49. And then in 2020, that guideline was updated. It's known as the Actuarial Guideline 49.A. And then most recently, we had another change in 2003. And for those of you that have been in the business and at least the past couple of years, you have noticed, maybe it's happened behind the scenes, or maybe you've picked up on it and heard a little bit about it. But we have had quite a few regulation changes over the past couple of years when it comes to how insurance or IUL products are illustrated. So moving on, right? And I will throw out a case study here. This will help us through this time frame, taking a look at how likely through these regulation changes a policy design was, the chances of it actually coming to fruition. So throughout the next couple of slides, we'll just be using these general assumptions to look at the probability of, again, that case design coming to fruition. So we're just assuming a male, age 45, preferred non-tobacco underwriting class, paying $25,000 of premium into a policy for 20 years, using an increasing death benefit, switching to option A or level, and then taking income out from age 65 to 84. And we're using 100% allocation to the S&P. Now, those case design specifics are not as important, but I do like to point them out. But it's going to be somewhat replicable to any client that you're working with as we're looking at this time frame. So a very straightforward case design for clients that are looking to have that tax-deferred growth that an IUL can offer, and then that tax-free distribution via a loan. So gentlemen, including Todd Pettit, much smarter than me, ran thousands of Monte Carlo simulations. So just know that this is backed and reviewed by our in-house actuary team here at F&G when we're looking at these simulations. So if you were to take a look at this chart here on the screen, right? In that exact same scenario, these are going to be different points on the screen of the likelihood of clients being able to take the likelihood that of the money that they're able to borrow from the contract and the percentage chance of that coming to fruition based upon those Monte Carlo simulations. So if we're able to illustrate $200,000 worth of income coming out, that would have nearly a 0% chance of coming to fruition. Whereas if we were to illustrate $100,000 worth of income, that has a 50% chance of coming to fruition. Or if we look on the left side here, nearing 100% chance of coming to fruition, that would be $50,000. So with that, right, again, pre-2015, the wild, wild west, believe it or not, carriers were able to illustrate north of 13% rate of return on an illustration. Keeping in mind that the regulation that went into effect in 1995 did not touch anything in regards to IULs. So again, there were many carriers out there that were just illustrating based upon how they interpreted guidelines. And we could, at that time, illustrate income north of $200,000 on an illustration. And in some cases, $244,000 worth of income that we could illustrate. Now, based upon these Monte Carlo simulations at that high rate of return, that had less than a 2% likelihood coming to fruition, right? So again, the wild, wild west, clients were purchasing policies, paying premium into their policy, and there were advisors out there showing them something that was very unlikely to come to fruition. Now, I'm not going to go through all of the regulation changes that we've seen, but if we jump forward just a little bit further to the most recent NAIC AG 49A regulation, which was nicknamed AG 49-B. This was launched in May 1st of 2003, and I won't go into all of the specifics, but it set in stone a lot of benchmarks that every carrier had to follow when it comes to how we can calculate illustrated rates, what we can use for the benchmarking of our best illustrating index strategies. And again, there are a lot of details to this. Even for me on a day-to-day basis, they don't really play into what I'm speaking to when working with advisors and customers. But again, it really set a foundation and minimum threshold that all carriers had to follow. And it really narrowed what carriers can illustrate. So it makes the insurance or IUL space a lot more competitive for us as carriers because we don't have the ability to, or I guess there's not a lot of loopholes for us as carriers to get creative with how we're able to get competitive in showing illustrative performance. But if we were to take a look at what the regulation looks like now, we're in a much better spot from a consumer perspective. So now we can, based upon those Monte Carlo simulations, we can illustrate on F&G's Pathsetter product, $92,000 a year worth of tax-free distributions coming out of the policy, which is significantly lower, right, than that $244,000 that we were discussing in that 1997 to 2015 time period. And this has a likelihood of 64% coming to fruition, right? So much more favorable for clients, right? We always tend to think that regulation tends to be bad, but in this instance, I believe, and us as a carrier think that these regulations aren't necessarily a bad thing, because we're able to present illustrations to our clients that are more likely to happen than not. And of course, right, if we were to show an illustration again with $70,000 worth of income, that has nearly a 90% chance of coming to fruition. So again, that's a look back into what we've seen really since IULs were launched. Regulations came into effect from 2015. So really, IULs have only been regulated for 10 years. And again, it's been in the client's best interest for these changes. So, right, what comes next? If we take a look at it, right? May 1st, 2023 was the last regulation. I had a call actually with Todd, our Chief Product Officer, this morning. He's very in the know when it comes to regulations. What I can say is we don't believe at this time there are any plans for the NAIC to come out with any new regulations, at least in the short term. Of course, they're always monitoring what carriers are doing. Carriers are very smart and they tend to find loopholes, right? Not to say that F&G is or isn't trying to find these loopholes, but the regulators are smart. Again, they're keeping an eye on things, but as of now, we don't expect any more regulation changes in the near future. The regulators have spent a lot of time focusing on the regulations and IULs, and they're somewhat ready to be done with it in regards to what carriers are doing, but they're keeping an eye on things. So what hasn't changed, right? The value of a fixed index universal life, right? There's the protection, the death benefit, the caps, the participation rates, those have not changed. The accumulation potential, the actual performance of an IUL, and then the spreads from a carrier perspective, right? We need to make sure that we're earning a reasonable rate of return to make sure that these products are profitable so we can continue to offer them. So all of the fundamental things that we talk about with consumers on a daily basis when it comes to IULs, those have not changed, right? These regulations have really been cracking down on what we can illustrate. Illustrations are required when it comes to selling an IUL, but the base fundamentals of what an IUL can offer is not changed. So what do we as a carrier believe it is going to happen next? Again, we think there are going to be carriers that are going to find loopholes. There are going to be good ways and bad ways for carriers to add value to either a policy or an illustration. So where we as a carrier at F&G think that there is going to be change is carriers are going to find ways, again, to have loopholes where they're able to show better illustrating performance. So they're going to find those ways that are going to show better illustrations so that way they benchmark better compared to other carriers. So they're going to show higher illustrated rates. We believe that higher illustrated rates can be a good thing, but if carriers are only focused on what's shown on paper in front of a client when you're either running an illustration, taking an application, or presenting it, is not really going. On the flip side, there are additional benefits that carriers can add or policy features that carriers can add that's truly going to add value to a consumer, right? So thinking of unique living benefit options that clients can add, maybe additional riders, unique features, different payout options. Those are all ways that we can add value as a carrier to a consumer without trying to play the manipulation game of just showing higher illustrated rates. So, right, 3 paths forward, in the words of Ted Pettit, right, we can compete in other other spaces when it comes to IUL. So these would be ways to add consumer value. So again, living benefits. Are there additional living benefits that we don't have in the industry, or maybe as a carrier we don't currently have on our products? The next generation of index innovation. Are there other types of IUL looking type products that would be really beneficial for clients? Maybe there's higher upside potential, but a floor that is a little bit lower than zero. Let's say the floor is -1%, but we can have a higher upside potential on our index performance. As Chris mentioned, right, we're getting into an age of digital underwriting, a digital experience. So how do we make the agent and client experience better, faster, less invasive underwriting, and customer service, right? I think those are all great things that we as a carrier and carriers across the board could add value. And we see a lot of that happening in the market currently, and F&G is certainly participating in that as well. And then, right, finding yield. Now, finding yield can be a good or bad thing from a carrier perspective. And we have seen since 2023, some carriers move in a certain direction. I won't say whether it's good or bad, but it's something to keep in mind as you're working with certain carriers. But a way to find good yield, right? For a carrier to find partnerships from an investment perspective, as Chris mentioned in the beginning, life insurance carriers earn money on the yield from their general account. So a consumer, pays premium. As a carrier on the life insurance side, we take out the charges and expenses, and then that money that's left over and goes into a client's account value or cash value is held in our general account. Then it's the job of our chief investment officer to go out there and find a safe but high yielding investment based upon insurance regulations that fits the mold, so we can earn a rate of return and offer competitive products, credit policy account value, come up with innovations. And for example, here at F&G, we partner with Blackstone Insurance Solutions to help manage our general account. They are an industry leader when it comes to investments. So we're partnered with the investment experts here at F&G to earn a high yield on our general account, unlike some other insurance carriers who do almost all, if not all, of that investment in-house. That would be a great way for a carrier to add value, is finding additional yield. Now on the flip side, right, maybe a bad way here would be creating a new benchmark portfolio, or what would be considered a new portfolio for strategies going forward. So essentially saying, taking a step back, most companies, well, not most, but companies have the option to either put all of their life insurance premiums into one bucket, or either old products and new products, old products, current products, and new products. That's called a portfolio method. So as yields go up, everyone is participating in the growth of that yield. Or on the flip side, you can have a cutoff date, whatever that date may be, where you have an old portfolio and a new portfolio. So that old portfolio is no longer weighing down the new products that you're offering, although the new product portfolio is going to be subject to this interest rate environment that we're in, right? It's currently very high, but for any reason it would come down sharply for the new portfolio money rate. Those rates would also come down, and our clients are not able, the clients that purchased policies, for example, 10 years ago, would not be able to participate in the uprise of the market and those higher interest rates because we have those portfolios split off. So we have seen a handful of carriers go to that old portfolio, new portfolio method. So if you've seen a carrier with a really high illustrated rate, maybe an illustration that looks a little too good to be true, it's worth asking, right? Are you using a new portfolio method? And if so, just something to keep in mind. It could or could not be favorable for those existing clients or new clients going forward. What I'll say is F&G, we are a firm believer and are fortunate enough with the portfolio that we have. We do not have any intentions to splitting up our portfolio. So we want to keep and treat our customers that purchased a policy 10, 15 years ago, the same as new consumers that are purchasing policies today. We have a really strong and consistent and reliable cap rate history on any of our index strategies. And that's certainly something that we're going to be able to offer in the future going forward. So, right, exploiting loopholes, that's also where we can see some changes from an illustration and product perspective. So maybe there are index-linked loans. I do know of at least 2 carriers out there that are getting creative with how they're showing loans on their illustration. Again, this is going to be a way for them to add illustrated value, but not necessarily consumer value at the end of the day. And then the BIA or benchmark index account methodology, carriers are going to find unique ways to interpret the regulation so they can offer those higher illustrated rates. Again, just things to be on the lookout for. A few other points, right, before diving into what makes F&G a carrier of choice. I do want to reiterate what Chris said in regards to underwriting. We're seeing this movement from accelerated underwriting to this the ability to offer underwriting decisions at the time of application. That's adding true consumer value to our clients. We're trying to make the underwriting and new business process easier, quicker, and faster for consumers. So that way it's less invasive, right? I always like to state that, right, especially for me, I don't want someone coming into my house from a paramed exam perspective, having me get on a scale, take my blood, I have to give urine, right? That's very invasive. So carriers are moving away from that. They're using a lot more digital underwriting options. So that way, again, we can make it easier and quicker for our customers. And then I also want to point out that I've noticed really since COVID, and for those of you that are on social media, there's a lot more digital ways for consumers to have telehealth visits. I don't know what this says about me, but I'll be transparent. When I'm scrolling on my Facebook or Instagram or whatever social media that would be, I'm getting bombarded with ads for telehealth, right? Do you have anxiety? Do you maybe have depression? Do you have ADHD? And it's very easy for consumers to go out there and quickly set up a visit with a doctor and be prescribed medication. Now, I'm not saying that your clients should not take care of their health, but it's being so accessible that these consumers aren't realizing that they're actually having a doctor's visit, getting prescribed a medication that could infect or affect their underwriting class. Again, for those clients that do have these types of conditions, they should be seen by a provider to receive the health care that they need. But it's so easy that they're not always in the know when it comes to completing an application. Say, hey, yeah, I was prescribed anxiety or depression medication a month ago, but they don't always think that they have to be transparent and share that when completing an application, which from a carrier perspective, we would like to know those things so that way we can assess a customer's risk, and that helps with a quicker turnaround time. So just something that me and a few others on the team here at F&G have picked up on. We've seen a lot more of that telehealth, which could ultimately result in a little less favorable underwriting class. And then, of course, as Chris mentioned, right, depending on how high these rates stay from an interest rate perspective, although it's not great for those out there looking to borrow money, potentially for a home, but it does help with the money that we can earn on our general account from a carrier perspective, being able to earn more money, turn that around, and put that into the products that we're offering for not only our consumers, but for you as our producers as well. So changing gears just a little bit, right? I do want to just throw in a few points about F&G. As I mentioned, we've had a really strong and incredible performance when it comes to our caps and cap rate history. When we're talking about borrowing money tax-free out of a policy, F&G has one of the lowest and unique variable or participating loan features. When clients go to borrow money out of their policy, we will never charge more than 5% for a consumer to borrow money from their policy. And technically, our variable loan rate can be lower than 5%. So as it sits today, our loan rate was 4.64%, capped at 5%. So for whatever reason, if loans do, or if interest rates do increase in 5, 10, 15, 20 years from now, when clients purchase a policy here at F&G, they'll never be charged more than 5% to do so, and it could be less. We have over 8 different index strategies available on our Pathsetter product. We have the reliable S&P strategies, and we also have some really strong and competitive volatility controlled strategies that offer a lot of upside potential along with that downside protection. And then living benefits. All 3 living benefits are included on our products here at F&G, so chronic, critical, and terminal illness. And clients can accelerate up to 100% of the death benefit, or $1 million. And then exam-free underwriting. I would like to say that F&G has been future forward when it comes to the underwriting space. And exam-free underwriting really was really innovative compared to other carriers' accelerated underwriting. And I'll just briefly explain to you all what exam-free underwriting is. So exam-free underwriting is a way for clients to get approved for an IUL without having to complete a pyramid exam, blood or urine. So if you have any clients that are between the ages of 0 to 60 and up to $1 million worth of coverage, we can approve them here at F&G without needing a pyramid exam, blood or urine. So every application that we have coming in the house that fits within these parameters, 99.9% of them, again, are approved without needing a pyramid exam, blood or urine. We can go down all the way to a table 8 or H. The only caveat here that I would say is that this is not a guaranteed issue or simplified issue type of underwriting program. So your client does have to be insurable. So my cheesy little joke here is don't sit outside of a nursing home or hospital trying to prospect for clients. So they do have to be insurable, but we have a great and efficient way to get them approved. 90% of our exam-free applicants are approved at standard or better. Again, we can go to table ratings if needed, depending on the client's health history. And then 50% of our exam-free applicants are approved within 5 calendar days or less. I've seen even quicker turnaround times. We're making improvements every day to help, again, speed up the underwriting process. Now, for full transparency, again, no pyramid exam, blood or urine for applicants that fit within these parameters, but depending on their health history, we know some clients are healthier than others. We may order a phone interview or an APS, very, again, non-invasive from a consumer perspective. And then, I would also say we're a great carrier outside of these parameters as well. So if you have someone older than 60, maybe applying for more than $1 million worth of coverage, we're certainly going to look really competitive and be a strong player there, but we would have a pyramid exam and possibly other routine requirements depending on their age and face amount. So with that, as we're seeing the industry change or move towards this ability to offer underwriting decisions at the time of application, F&G is playing in that space as well. Just to give you an idea where we're at currently, this is going to be in addition to exam-free underwriting. So we call it instant approval. Again, that means you're able to sit down with a consumer, fill out an application, and clients that fall within these parameters will be able to receive possibly an underwriting decision once you submit that application. So who is possibly or currently eligible for instant approval? It would be juvenile applicants, so ages 0 to 17, applying for up to $500,000 worth of coverage. Clients between the ages of 18 and 60 applying for up to $1 million worth of coverage, and assuming that they're eligible for the best underwriting class depending on their age and the face amount applied for. So we've been seeing a really great throughput. I would say about for juveniles, we're seeing about 40 to 50% of applications being approved at the time of application. And then for our ages 18 to 60, we're seeing about 20 to 25% approved at the time of application. Now, the great thing about instant approval and what we offer here at F&G, for whatever reason, we're unable to approve the client at the time of app, they seamlessly move over to exam-free underwriting. So we will not require that pyramid exam, blood or urine. And again, this is a way for us to offer that quicker underwriting process for your consumers. And this allows you as an advisor to work on your business and not in your business, right? You're able to help and assist with more clients if you can get them through the underwriting process quicker. And then, right, as we're wrapping up, again, you have a fabulous team over at IAD to help you with whatever you may need, but you've certainly got a great team here at F&G to help out. You're not in this alone. If you have questions about what we covered today, you want a copy of that recording from Todd Pettit that I mentioned, or you have product or illustration needs, feel free to reach out to us. You have myself, the National Account Manager that supports all of you. And then I like to call Sandy my right-hand lady. I'm often on the road giving presentations. She keeps everything moving behind the scenes. And then if there's one number that you write down or that I recommend, it's right here on the left-hand side. It's the 800-357-8734. We have a team of 15 internal wholesalers who are on the phone, ready to help. For any reason, if you can't get a hold of me or Sandy, feel free to reach out to them. They're very experienced. But with that, I'm going to go ahead and hand things back over to Tyler and Bernard. Appreciate everyone's time today. And if there are any questions, I would be happy to stick around.
Hey, Miles, thank you, my friend. Very informative. I mean, we have a couple of minutes. So if anybody has any questions for Miles, now's the time to ask Miles those questions. I think I saw a hand raised from here. Durga, if you have a question for Miles, go ahead, my friend. Here, let me see. And here, Arlene. And let me see if we can get you. Yeah, there you go, Arlene, to see if you can ask your question to Miles. Oh.
I'm sorry I did that by accident.
No, that's okay.
Yeah,
I have
oh, there we go. Go ahead, Chris.
I was just say I got a question for Miles, and I think somebody else did too. They were kind of wanting some explanation of Monte Carlo simulation, what that meant. Are you able to elaborate what F&G is doing with that?
Yeah, absolutely. I appreciate that question. And certainly Monte Carlo simulations are very common in the financial services space. A lot of it probably happens behind the scenes, but it's essentially, and I said, thousands, if not hundreds of thousands of Monte Carlo simulations were ran for those designs. So it's essentially, right, just thousands of random of simulations performed. So based upon various economic conditions and past performance, if we would have all of these simulations running, what is the likelihood of these outcomes? So instead of just running a few samples, right, maybe 10, that doesn't give us a good outlook on what the possible outcome could be. But if we run thousands and hundreds of thousands of sample outcomes, that gives us a better idea and bell curve of what we could see actually happen in the future.
His ears are even moving?
All right, Arlene, go ahead.
No, I had nothing to ask.
Okay. All right. Thank you.
Yeah.
And we will say we've had a lot of success with F&G's underwriting from our agents using it. What Miles is saying about it being accelerated is definitely true. Most of the cases we've gone through, all of them that I think of that I've ever seen funnel through IAD have all been non-paramed. So as far as those clients that are anxious to get things done and get things moving, and you moving on to the next client in case F&G is a strong carrier to go with.
Appreciate that information, Tyler. It's always nice when someone can validate that. and you, right, you don't have to take my word for it, right? Just to give you an idea, F&G issued 125,000 contracts last year. And I believe more than 50% were through exam-free underwriting. I want to say right around 80 to 85%. And again, there were maybe one or two where we had to ask for a paramed exam. In those cases, right, I don't want that to scare you, but it's because the client was declined by a carrier that they submitted an application on maybe a month or so ago, and they wanted to try our exam-free underwriting. And the only way we could maybe offer coverage is taking a look at those paramed results. So again, very unlikely to happen. Less than 0.01% of the cases would we even ask for a pyramid exam on.
And Miles, another quick question. Are those slides available for agent use, or is that entirely F&G intern?
Yeah, that would be that. You as advisors, you're more than welcome to review them, the slides. I will provide you, Tyler, with a copy of those, a PDF copy. They're not consumer approved, so please keep that in mind. It's not something that you can necessarily present to your clients. But if you, as an agent, want to take a deeper dive and take a look at the slides, feel free to do so, and I'll pass those along.
Excellent. Thank you.
All right. All right. Thanks, Miles. So next on our agenda is Alan Relman. Alan Relman is an attorney. And this guy, when I tell you he's great at what he does, he's going to provide you with a lot of great tax information. And then a lot of that can also be used, will tie into IULs as well. Alan, my friend, take it away, sir.
Bernard, I'll pay you later. I appreciate the accolades. Hey, first of all, I want to thank Tyler and Bernard and the Insurance Advisors Direct the team is so strong, and I actually didn't know until about an hour ago that I ran an IMO myself, and I was in the same building as you guys, and you guys have just carried on. You know, it's all about reputation in this industry, and your reputation is stellar. You guys can't be touched. So hats off to the team at Advisors Direct. I'm going to give you a little bit for everybody who's tuned in, grab something to write with. I'm going to start off with giving you my own personal information for contact. And obviously feel free to go through Bernard or Tyler first, no issue whatsoever. But I want to make sure that you have my contact information. Is my voice okay and everything's smooth at this point? Okay, making sure. So I'm going to give you my contact information. I'm also going to be going through some notes on strategies that really a lot of folks should be starting right now. It's February, right around the corner. 1099s are coming, so I'll walk through that as well. I'm then going to move into some strategies that we have available this year. Believe it or not, I had about a 25 slide PowerPoint that we could have done today. About half those slides are now obsolete because by the time I get them through compliance, it just ain't going to happen. So I'll walk through the highlights, but there is some legislation that happened middle of last year that we need to all be aware of. So for starters, my contact information. So I'm going to give you my actual cell phone information. My cell phone is sitting right here. This is the cell phone you're going to be calling. My cell phone, first of all, my name, Alan Roman, A-L-A-N, Roman, R-O-M-A-N. I am an attorney. Part of my role is to help you build your business, help your clients with tax questions, legal questions, and strategies. A part of my rules of engagement is I can actually get on a phone call with you and a high net worth client. You and I just have to call, talk initially so we know what's going on and we're all on the same page. I will tell your client that although I'm a licensed attorney, I will not be their attorney, but because they work with you, they get me for free. Email address. So cell phone number first is 561-402-0315, 561-402-0315. I'm on Eastern time zone. I'm directly south of you guys a little bit. It's called Florida, but I was a Detroit guy for 40 something years and just moved down here about 15 years ago. And I go back a lot. So that's my cell phone. My email address, Roman, A-R-O-M-A-N, at truechoicefinancial.com. Roman at truechoicefinancial.com. So you've got my cell phone number, you got my email address. Rules of engagement, there are none. You got a question on a tax situation, just go ahead and call me. I will try as best I can to keep Tyler and Bernard in the loop on stuff, but bigger cases, absolutely. My background actually right in the building that you guys are in. I did some significant travel all across the country for many years and ran into a lot of situations that I I can tell stories about and how to do it and how not to do it. What I want to talk about quickly is the end of the Tax Cuts and Jobs Act. I don't know how many people are tuned in today, but the Tax Cuts and Jobs Act came out under Donald Trump's first term, and it expires as of the end of this year. Actually, as of January 1st, 2026, the Tax Cuts and Jobs Act by law expires. That doesn't mean they can't extend it. Obviously, what happens between the White House and Congress is going to have a lot to do with that. There are a couple things that will change and a couple of the things that won't change. If nothing changes right now and the Tax Cuts and Jobs Act expires at the end of this year, income tax rates really won't change very much. Capital gains tax rates won't change very much. There's a lot of things like the state and local taxes that will change. But the biggest opportunity that we all have right now, again, no clue if it's going to be extended or not, if the Tax Cuts and Jobs Act will be extended. But as of right now, all of your clients and all of us have the ability to not only make our annual gifts, which right now the maximum annual gift is $19,000. That means I could give everybody tuned in $19,000. My wife could give everybody $19,000. So that's $38,000 per recipient. I don't pay gift tax. You don't pay gift tax. We don't even have to file a gift tax return. If I give Bernard or Tyler $1 over 19,000, that $1 eats up $1 of my what's called my lifetime gift exemption. Believe it or not, even your highest net worth clients may have no idea what the lifetime gift exemption is. But as we sit here today, I can give, on top of all those $19,000 annual gifts, I can give away another, it's just a couple cents under $14 million. It's 13.99 million. My wife can give away the same amount. So if planning is done properly, if gifting is done properly, we could literally take $28 million out of our estate, put it in a trust for our kids, give it directly to our kids, give it to whoever we want, remove those assets from our estate, never pay a dime of gift tax. Of course, I won't pay any gift tax because I don't pay gift tax until I'm dead. Okay. My kids would have to pay it. But it's an opportunity that you don't want to walk away from. At least open the conversation with your high net worth clients. If they're confused, and they probably are, I've had clients worth $100 million who have no clue what a lifetime gift exemption is. Just write down lifetime gift exemption. That's something to bring up. Let your clients look it up. So that goes from what is now 13.99 million as of January 1st of next year. It's going to drop to between 6 and 7 million based on cost of living. So you have an opportunity to talk to your clients about moving money. What does moving money to the next generation do for you? It builds a relationship with the next generation and the next generation. I've had success stories like beyond, just that you can't believe, on having people make these gifts, lock the gifts in this year before the end of the year, because it's literally right now, don't know what's going to happen in the White House. Right now, it's use it or lose it. Take advantage of as much of that 14 million each you can. All right, so that's estate and gift taxes. Keeping in mind that the estate tax rate is 40%, flat 40%. So if I die with $1 million over my $14 million, it's a 40% gift tax. Gift tax. It's a 40% estate tax or gift tax, one way or the other. I can give it away or die with it. I don't have a lot of time, so I don't want to spend too much more time. But call me with questions on gifting. I've got story after story about how financial professionals built relationships for multiple generations just by trying to influence gifting. Right now, it's February. Your clients are all getting their 1099s. They're all becoming aware, if they weren't already aware, they're becoming aware of their current tax situation for this year. This is the perfect time for financial professionals to be making appointments. Doesn't have to just be your high net worth clients. Those strong relationships, those stronger clients, get in touch, try to set something up. If you can set up a meeting with them within 30 days from now, so you still got another 30 days before tax returns are due, but they'll have a pretty good idea what their income is going to be this year. Why not take advantage of this year's income tax rates? there's a lot of folks that are tuned in that are thrilled with the election. Some are not. I'm not going to go there. However, I can say that good things are happening already financially. What I will say also, I don't know where things are going. 4 years from now, we'll have a different president. Don't know what'll happen, and I expect to be alive in 4 years. I do. So I would take the advantage right now of whatever tax rates I can. If I know, for instance, and this is a common situation, married filing joint clients who are in the 24% tax bracket. 24% tax bracket starts at like 200,000 roughly, goes up to almost, I think it's just over 400,000. I could take say I'm 60 years old, which I am. I could take money out of my IRA. I could pay tax on it now if I wish, drive my tax rate up or my tax bracket up, but stay within that 24% tax bracket. So say I put in, I think I can go up to about $425,000. A lot of clients that I'm on the phone with financial professionals, their clients are 7-figure IRAs. That's a ton of money that's going to be fully taxable in retirement. So if you happen to know now, February or early March, that your clients are going to have roughly $250,000, they have it for 2024, and they're probably going to do the same this year. Talk about moving money out of an IRA, qualified money, turning it, whether you pay tax on it directly or whether you do a Roth conversion. Think about operating with that client, a conversation about how do we move some money so it's after tax in retirement. Let's diversify our taxable income in retirement. So maximizing your tax bracket, I call it tax bracket maximization. It's a conversation, and a lot of great stories have come out of that. Capital gains taxes right now, the maximum capital gains tax is 20%. Not so bad considering that under Joe Biden, the first pieces of legislation that came through raised the top from 20% to 40%. If you have clients with appreciated assets that they're thinking they're probably going to sell them in the near future anyway, have the conversation about locking in at worst case a 20% long-term capital gains rate. So I got long-term capital gains. We've talked about maximizing your tax bracket. Gifting is just a spectacular opportunity for all of us. Those are my top 3 areas of questions. I get questions from financial professionals literally across the country. And the questions vary, and I will walk through scenarios or walk through some ideas, but don't let the February and March tax seasons go by without contacting your clients to set appointments. Those are like your immediate things that you need to talk about. So income tax bracket maximization, think about taking some long-term capital gains off the table, paying your 20% at worst case and be done. Definitely lock in your gifting opportunities because it is literally right now, use it or lose it. They're most likely the Tax Cuts and Jobs Act will be extended. But again, you got to fight through Congress to figure out when and where and how that happens. Again, the conversation time is now. So enough said about those top 3. I want to walk through 2 pieces of legislation from the middle of last year that have affected a lot of financial professionals and their clients, but especially these 2 subjects have paid, on any given day. So right now it's about 11:05 Eastern time. I've already had 3 calls this morning just on these 2 subjects. Okay, the first is relating to inherited IRAs. Now, this came out middle of last year. There was a final regulation from the IRS. I'm going to walk through the typical scenario, tell you what the ramifications are, but take some notes on this. So when Trump first came in, the Tax Cuts and Jobs Act came in, and we had what was called the Secure Act, and the Secure Act changed the way that inherited IRAs effectively are taxed. What they did was they wanted to accelerate taxation. Clearly, the federal government wanted some more revenue, so let's accelerate some tax money. The way they did that was they took what was a standard option, non-married. Say your son or daughter is the beneficiary of your IRA. they could have, upon death, they could have stretched it out over their lifetimes. So could a spouse. The spouse has different options than just family members. As of the Secure Act, that changed. So what happened with the Secure Act, this is effective 2020, basically. That non-spousal beneficiary of my IRA, my son, my daughter, my brother, whatever, they had to they had to take money out of the inherited IRA within 10 years, and I'll tell you how that 10 years is measured, and pay tax as they got the money. So basically, the IRS is trying not to allow my younger brother or my kids to just stretch out over their lifetime. They want the revenue faster. So the way it works is, I've got a non-spousal beneficiary. It's my son and my daughter. They're going to split my IRA. I kicked the bucket. I died after the Secure Act, 2020. So I'm in the Secure Act. If I died on February 18th of whatever year, my kids have till December 31st, 10 years later. If I died in 2022, my kids would have till 2032, December 31st, to take all the money out. No required distributions, since I didn't start distributions during my lifetime. Okay. So the basic standing situation is, I die, I haven't started RMDs, my kids inherit my IRA. They've got to get all the money out by December 31st of the 10th year after I'm gone. But they don't have to take any money out in any given pattern or any given year, and they don't have any RMDs to take out. The IRS, when the Secure Act came out, they hinted that they didn't like the idea that if I had started RMDs, those RMDs would stop. My kids would have 10 years. So believe it or not, it took 3 years. Actually, it took 4 years, because it didn't happen until the end of last year. It took 4 years for the IRS and Treasury to get together and come up with what they call final regulations that say, oh, even though the Secure Act didn't talk about this, this is the way it's going to be. So how this works now is as follows. This only applies when the person who died had started their own RMDs. So to make it clear, if I hadn't started RMDs, this is moot. If I had started RMDs, there's a different pattern here. Here's what we got to do. So starting 29 days ago, January 1st of this year, this is the first year that somebody who inherited an IRA from someone who had started RMDs and is not a spouse. There's so many little tricks here. Non-spouse, doesn't matter if it's a spouse, it changes. But the bottom line is, if I die and my kids inherit my IRA and I was taking RMDs, they have to start taking RMDs in 2025 based upon their life expectancy, not mine, theirs. So if I was taking RMDs and I was 65 years old, didn't have to take any RMDs at all. But if I was taking my RMDs, my kids would have to take their own RMDs starting this year and still empty the account by December 31st of the end of the 10th year. So this is tricky. This is, like I said, this is why I get so many questions on this. I'll say it one more time. I die. I was taking my RMDs, say I'm 75 years old. I'm taking RMDs. My kids inherit my IRA. Starting in 2025, they have to take an RMD over their life expectancy, and they still have to empty the account by December 31st of the 10th year. I'm going to stop here because I get so many questions. Maybe someone's going to throw a question out here. Just let me know, Bernard, if anything comes up. But again, this is a very complex scenario, and it is, like I said, by far it is the number one question I get. How are we?
Yep. Any questions actually, I have a question for you, Alan.
Yeah.
A couple of months ago, I wrote an annuity from an inherited IRA.
Yeah.
Now, let's just say and it's not this case, but say I pass away, my kids are, say 30 years old.
Yeah.
And in 10 years, they'll be 40. Will they be charged that penalty for not being 59 and a half?
So
Or
great. So great question. So what Bernard is asking is, if I take money out of an annuity or if I take money out of an IRA account before age 59 and a half, I pay tax and I also have to pay a penalty. Now, upon death is one of the exceptions to that 10% penalty. So if I hate to say if Bernard passed away, but this is this is your case. So if God forbid, Bernard, flew out to California, put some fires out and didn't come back. The IRS wants your kids to take that money out as soon as possible because that's when they get their tax money. So that 10% penalty is off the table, and the exception that applies would be the death of the person who held the account. The IRS wants them to take it out quicker if they can. That's why if Bernard had started taking RMDs, his kids would have to figure out their own life expectancy as of 2025 and take a little bit of money out this year. If he had passed away in 2024, they would have till 2034, December 31st, to empty the account. So what this does, like we've got scenarios that go back a few years. Say they go back 4 years till 2020. We've got situations where, most situations, if this is a scenario where the individual had passed away and was taking RMDs, if the kids inherited it, they haven't taken any RMDs because no one told them they had to. Well, they do have to start their RMDs in 2025, but that 10-year rule doesn't get extended. So now they've only got really 6 more years left to go. So they'll take RMDs for 6 years, and the account's got to be emptied by December 31st of that 10th year. So great question though. Does that answer? Does that answer the? Yeah, the IRS at this point, upon someone's death, the IRS just wants the tax money as soon as possible. If you take it out really, really soon at a really young age, they'll probably send you some flowers. Yeah, so no issue whatsoever. So, like I said, the most complex question I get and frequently is inherited IRAs. And by the way, while Chris Schaefer is still tuned in here, I'm product agnostic. I'm here to help you open a case, close a case, talk to your clients, all strategy. Chris is within True Choice, and we're a pretty big company. Chris is the #1 insurance expert in our planet. He's just got it. And he is, to the extent of carrier, he's product agnostic. Let's get the best product for the client. So Chris is he's a phenomenal resource for you. Don't hesitate to give Chris calls on opportunities. Doesn't matter the type of policy, whether it's term, whether it's IUL, whether it's, got different links in there, but Chris is the guy. So hats off to Chris for tuning in. If we don't have any additional questions on inherited IRAs, I'm going to move to another relatively complex area. Write down, this is for your business owners, write down the name Connelly, 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 Connelly. Connelly is a Supreme Court case that came out the middle of last year, the middle of 2024. And effectively, it changed some of the pre-existing rulings on estate planning with buy-sell agreements, life insurance, things like that, especially buy-sell agreements. So the first thing you want to write down about this situation is, and I would quote this, because of the Connelly case in 2024, you should be in contact with all of your successful business owner clients. So if I got 27 business clients that I know they've got a business, they may or may not have a buy-sell agreement. And by the way, I do review buy-sell agreements free of charge, by the way. But for you to be making phone calls to all of your clients, it's a high priority. It's probably a close second to looking at your February client situations for taxation, income taxation. Connelly changed the way that a buy-sell can and should be drafted. And I'm going to walk through how it works and what to do and what not to do. So in a nutshell, all clients, if they're successful business owners, should have a buy-sell agreement. between them with their partners, with their shareholders. If there's family members, especially, they should have a buy-sell agreement. So everybody knows what happens when somebody dies. The standard operating procedure for, let's say Tyler and Bernard are business partners, and they want to make sure that if something happens to one of them, the other one, not only does the other one have liquidity to buy out the estate, for the shares, but also want to make sure that the business continues to run smoothly. So if I'm the attorney and I come in, and if I'm drafting an agreement, I might draft an agreement between Tyler and Bernard, and we would have a business valuation done. This is very, very key because many people don't bother with the expense of a business valuation. They just agree that the business is worth $5 million or $3 million or whatever. You really want to get a business valuation done. It's actually key, and it's one of the ways to offset the ramifications of the Connolly case. So I might come in and I would draft a buy-sell, and I would call this thing, it's called the cross purchase. And here's how this thing works. We write up an agreement. Tyler is going to own a life insurance policy on the life of Bernard. Bernard is going to own a life insurance policy on the life of Tyler. Let's say the business we've had a business valuation and it's worth $4 million. So right now we're looking at $4 million of equity. That means that the policy that each of these gentlemen own on the other has to have at least $2 million of death benefit, right? So God forbid, Tyler goes outside, he gets hit by a cement truck. The death benefit pays to Bernard. Bernard receives a tax-free death benefit. He executes that cross-purchase agreement. He sends a check to the widow of Tyler, and in return receives Tyler's shares. Okay, that's the step-by-step. Tyler's widow walks away. She's got the money. She's good to go. I mean, she misses Tyler, but she's good to go. But more importantly, Bernard now has the shares. He owns 100% of the business. And even though he received a couple $1 million of tax-free money, he pays no tax on it. And he now has 100% of the shares in control of the business. But what else happened? Because Bernard received that check and turned around and wrote a check to the widow of Tyler, he just created a couple $1 million of cost basis and didn't pay a dime of income tax on the death benefit. So it's this is by far the cleanest and the simplest way to do it. It's called the cross purchase. The Connolly case was a cross purchase agreement, but they put a little twist in which made it stupid. So when you're contacting your business clients, you're going to talk about the Connolly case. All you have to say to the client, without going into any of this detail, is because of a case that came through the Supreme Court, it's called the Connolly case, you really need to go back and review your buy-sell agreement with your attorney. And by giving them that advice, you are really helping them out, because many folks are either not aware of the Connolly decision or haven't taken a look at their buy-sell in years. So here's what the Connolly case involved. Two brothers, they owned a business. They never did a business valuation. Stupid, and this really hurt them. But they agreed that the business was worth $6 million. It just seemed like the right number, okay? So rather than do a cross-purchase agreement like we discussed, where they each own a $3 million policy on the other, and then you would never even have heard of this Connolly case if they had done that. They wanted the company itself to own the policies. Okay? So what happened? One of the brothers died. $3 million life insurance policy came into the business, and the business then redeemed the stock of redeemed the stock of the deceased brother. So the widow walked away with her $3 million. And then the stock that the company had redeemed didn't go directly to the other partner. It was just retired. This is called a redemption style agreement. So we had cross purchase. Keep it simple. I buy policy on you. We transfer money as needed. Redemption style is different. The business entity itself receives the death benefit and redeems the stock, retires the stock. The surviving partner now owns 100%, just like in the Tyler Bernard case. Problem is, although the surviving brother received $3 million worth of additional value, he didn't pay a dime for it. So his cost basis didn't go up. Now, that's just the practical problem. The worst problem is what the Supreme Court agreed with the IRS on. $3 million came into the business. $3 million didn't go anywhere. What happened was the stock of the individual that died was redeemed. So that $3 million went to the surviving spouse in return for stock which was retired. The surviving partner now owns 100% of the business, didn't pay a dime for it, so his cost basis is a problem. The bigger problem is the IRS said, unlike a cross purchase where there is a requirement to buy the shares across from each other, in this type of an arrangement, the $3 million counts as additional value to the business, but the $3 million that redeemed the shares was basically an even swap shares for cash. There was no reduction in the $3 million. What happened is the gentleman that passed away, they filed an estate tax return, and they assumed that the $3 million that came in went out to redeem shares. It's a wash. IRS and the Supreme Court said, nope. They traded $3 million of cash for $3 million of stock. The $3 million value is still there. The IRS hit the surviving spouse of the deceased $800 and something thousand of estate taxes, penalties, and interest. So where we are right now, you're going to get in touch with your higher net worth clients, especially business owners, successful business owners. All you want to talk about with respect to Connolly is give them the name Connolly. Tell them that they need to review their buy-sell agreements. When they come back to you, they may say, we don't have a buy-sell agreement. That's even worse. But you're helping them light a fire. You are lighting a fire under those business owners to at least have them have some interest in going after a conversation with their attorney, making sure that things are clean and are set up properly. Any other questions coming up here? It looks like we might have one. I can't tell. Let's see if I click here.
That is a question on True Choice. I'll answer that real
Okay.
Quickly. True Choice is a company like Roaming Advanced Planning Attorney. Well, we have advanced planning life specialists that work with insurance advisors direct. So if Tyler and I, we don't have the answer for a particular advanced case, we will go on over to True Choice and ask Chris Schiefer. So that's just part of the resources that we offer our agents. So the knowledge that we have, and we're all a team. So like I say, if Tyler, myself, we don't have the answer, we're gonna go to True Choice to find that deeper answer to better help your client. So they're an additional resource that Insurance Advisors Direct has.
Anything else? I can't see.
It's like something else. Noelle, how to get in touch? I'll give everyone a call after this, so we'll get dots connected thereafter. A big point to take here from what Alan Roneman was talking about is, number one, the resource available to you, and number two is right now AEP is over, OEP is over, all these big events are all over. So this is kind of the off season, so to speak, for a lot of what you guys, I've seen your names on here, what a lot of you guys do. So you may have time now to look for these opportunities for specifically inherited IRAs, either what Alan was talking about or prospective future inherited IRAs. What is the idea? Like, you all work with the senior clients. What have they even thought about what a tax plan would look like for what they're going to pass on with their qualified accounts to their beneficiaries? Most likely not. And this is something that you can bring up to them and bring it right back to here to Alan, to me and Bernard, whoever it may be, and we can get a good plan for your client together. It's a great opportunity or a great hunt, for lack of a better term, during the off season now, especially when everyone's already thinking about taxes, like Alan
Yeah.
touched, because of the returns. There's a lot of opportunity out there for your middle class clients to your higher end clients. Doesn't matter who it is. Everyone needs some sort of plan for passing on qualified assets.
Yep. Well, I'm going to pass it back to you, Tyler. I'm just about out of time, but whatever questions come up, you guys have my contact information. Again, tax bracket maximization. Take a look at the capital gains. Why not, rather than avoid capital gains, let's pay 15 or 20% versus what it might be in the future. And those gifting opportunities are key to not only estate planning, but they're key to relationship building for all of you. So I'm going to turn it back over to Tyler.
Yeah, so thanks. That was a great presentation and thanks for your time. So lastly, I believe we have just a touch of the long-term care space hybrid outlook from Chris Schaefer. And then we're moving on to just our final touch on our marketing reimbursement program through IAD and some giveaways. So the funner stuff at the end. But I think one more topic we'll talk about is LTC hybrids from Chris Schaefer here.
Tyler, did you say there's giveaways?
There'll be some giveaways, yes. You don't qualify.
Darn it. All right. Well, good morning, everybody. Again, I appreciate Tyler and Bernard having me here to help out. What I'm going to talk about right now a little bit, and I am going to pull something onto the screen as well after I go through a few notes here. Like before, and like what Alan said, do me a favor, have a piece of paper, write some of this stuff down. More importantly, just get the gist of what I'm talking about. Okay. I want to also be very clear with everything that we talk about here. Make sure that you get in touch with Tyler and Bernard to go over this stuff. Okay, they truly could help you out. We all work as a team here, and what I bring to the table is back office support for them. Okay, and so the thing that I'm going to talk about a little bit is again some key trends, kind of the outlook, what's going on with long-term care today. And where and how is it important for you to discuss this with your clients? Okay. So first of all, some information, right? There truly is increased demand. Okay. We got an aging baby boomer population, and this really is what driving the higher demand for long-term care services. Okay. What this shift means is that more people are considering long-term care insurance to cover potential future needs. Now, when I continue to go forward, be clear here. Don't think of long-term care just as something that's going and paying bills if you're in a nursing home. This stuff helps you when you're in home. Okay. This stuff also is extremely important to make sure that your clients and their children understand how this works, because it can heavily impact the retirement of both of those generations. All right, so we got rising costs, right? Long-term care policies, they continue to go up. One of the things that I'm going to talk about with my slide is some of the differences between traditional long-term care and where the industry is going to hybrid products, okay? Technology, okay? Again, just like with life insurance, a lot of long-term care today is being done in the hybrid space, they call it, or as riders on long-term care. So technology and underwriting is things that are really being involved with how this gets done. What also is causing some industry issues with long-term care is workforce challenges, okay? There truly is issues with having enough people to give the care that's needed. Okay, it's impacting the quality. It's also just impacting if somebody's there. So what this means is a lot of times children are having to step in, or the services given, the care facilities are having to pay a lot more money to these nurses and folks to come in and work there, which in turn is costing the client more ultimately, right? Causing the person that's going into the home or needing the insurance, it's costing more money. Regulatory changes, okay? We're constantly having changes and policies that help to change that around. One of the big ones is the IRS actually increased the tax deduction limits for long-term care insurance premiums. All right. Do me a favor. Make sure that you reach out to Tyler, reach out to Bernard. Those two guys could help you understand where some of these premiums are that could be deducted and tell you how that works. Okay. Affordability, I spoke about that, right? That's a challenge. Awareness. Many people are still unaware of the tax benefits and the complexity. These are some of the things that become challenges that you have because one, you got to make sure that you at least have a high level knowledge of that. And two, you want to make sure that you're able to communicate that over to those that you're talking to, right? Remember, those that you're talking to aren't just going to be folks that are 60, 65, 70, 75 years old. A lot of times, and what we all talk about, I know the guys at IAD are real big on this too, is make sure when you're having this discussion that you have the alpha child, right? Who's the child that your client has that's going to help them make these decisions? Don't be afraid to talk to them. Pull them into that conversation, make it happen. That'll make everything better, okay? Innovative products. These are some of the great opportunities, right? Opportunities for you as the advisor and for the client, because we could go ahead and do some things there where you don't have to worry about premiums and stuff like that with those going up. Tax incentives, I spoke about that already, right? So, but before I go into a little bit on some of the products, in conclusion, the bottom line is the long-term care industry is really going to be growing. I mean, it's been growing for years and it's going to continue to grow. And it's driven by more people aging and those demographic challenges, right? It's growing because, quite frankly, people that are in care or getting close to care, their kids now are right at the spot where, one, they either need to step in and help take care of mom and dad, but they also need to start looking at it for themselves as well. The opportunity for you all on this presentation or on this call today is in long-term care. Talk to people about it. Bring it up. All right. When I share my screen right here, I'm going to tell you why you want to make sure that you bring that up. Okay. Can somebody please let me know? Are we able to see the screen here?
Yep.
All right, so when we look at this, right, and these are some tools that I know that IAD has. They showed them to me. So planning for long-term care, what you need to know, right? And this is something you all can get your hands on. You can put your name and stuff in there however you want. But here's the bottom line on why you want to talk about this. Everything I spoke about before, but check this out. Anybody turning 65 today has a 70% chance of needing some sort of long-term care at some point in their lives. Listen, if you're sitting down with your mom and dad, 2 out of 3 of you at that table is going to need this care at some point. That's the number. That's scary, but you know what? You're able to turn around and help your clients make it not that scary, okay? After the first year, the average person receives care for an additional 3.3 years. So listen to that. On here, we say 3.3 years. The truth of the matter is the number's 4.3 years. I'm going to do some math for everybody here. Okay, I'm going to do some math just real quick. So if we say where you guys are in Michigan, I haven't even looked it up. We'll even go low on here. Let's just say the average cost per month is $8,000 to be in a long-term care facility. Once you're there for a year, they say that you'll be there for an additional 3.3 years. So that's 4.3 years. Okay. That would be 51 months. 51 months times $8,000. That is $408,000. Okay. That's a lot of money. A lot of money. Then we turn around and we look at people with Alzheimer's and dementia. Okay. They generally could be in one of these places for 4 to 8 years. People could live for 20 to 30 years with that. All right. A couple more things to think about when we look at long-term care, on top of rising costs, on top of the fact that 70% of people are going to have a need for this, okay, is this. You need to really understand with your client is, how does it affect my retirement strategy, right? You need to understand some of these other things too. I'm just hitting on these things high level, so I'm not going to talk about all of it. What I really want to get at here is what are the options that we have, okay? What are the options? And Tyler and Bernard could get this out to you so you all could talk about this in further detail with them. But bottom line, when you talk to these people, again, of which we know 70% are going to have a need for this, some of them are going to talk about self-funding, right? They're going to talk about self-funding. What does that mean? That means using their own money, right? They're going to have to drain $400,000 out of savings or money markets. If they don't have it all there, they're going to have to take it out of annuities and IRAs. What's the problem with that? Got to pay taxes. Okay. If it's a variable annuity that they have, or if it's if the IRA is invested in mutual funds, which 99% of all IRAs are in mutual funds or ETFs, what if they have to sell into a down market? Right? Big problem here, folks. Stocks, bonds, mutual funds, same thing I just said. Real estate. Oh, I owned, my parents owned 3 buildings that they get, or 3 homes, they got renters. Well, what if some of those renters leave right when mom and dad have to go into one of these homes, right? Now there's less income coming in. Now they got to sell the place to get the money. Oh, well, Medicaid, that'll pay for it. No, not until they're desolate, right? Not until they've gotten rid of all their assets, pretty much. Hey, you could go with traditional long-term care, right? Traditional long-term care, the bottom line is this. You go into a nursing home, you're permanently going to be there, it'll go ahead and pay. But there's lots of problems with traditional long-term care, increasing premiums, use it or lose it propositions, right? A lot of problems with that. So why not come and start looking at the stuff that I know the folks at IAD do a ton of this each and every week, okay? Why not look at life insurance with an optional long-term care rider? What happens there? If you need long-term care, you got the long-term care. You pass away, it's not use it or lose it like traditional long-term care. There's a death benefit that's going to pay out. Or you can look at the linked benefits or the hybrid type plans, which are going to do the same thing, right? They're going to give you long-term care with inflation growth and all that sort of stuff. If you pass away, all your money comes back. If your needs change, there's a portion of it that's a return of premium option. Okay. So the bottom line that I want all of you know today with my conversation is what's going on in 2025 when it comes to long-term care is there's increased demand, right? Increased demand. More and more people are coming of age that these things are hitting them. 2 out of 3 folks, right? 2 out of 3, 70% are going to need it. Rising costs, which causes premiums on traditional long-term care to go up, okay? Why not go ahead and look at some of the advancements in the industry and start looking at things that aren't use it or lose it, that have better underwriting options than traditional long-term care, and truthfully bring more value to not only your client, but you as the advisor. One last thing I want to leave you with, and then I could answer some questions, but I'll turn it over to Tyler and Bernard. One last thing here is this. 70% of people turning 65 will need this, okay? But in the first 2 years, I didn't say this stat, in the first 2 years, 80% of all care is going to be done at home by the oldest daughter or daughter-in-law. That's what the statistics show. Now think about that. If you're the oldest daughter or daughter-in-law, how does that impact you? How does that impact your family, your job, and what you're doing to try to earn money, to try to get to retirement, to try to have enough money in retirement to retire, right? We all want to take care of mom and dad, and probably will have to at some point. But the nice thing through working with the guys and learning this, and you all helping your clients out, you can make sure that that's not a problem for them. So again, let's just remember there's trends, there's challenges and all this sort of stuff. But the bottom line is you as an advisor have an opportunity to talk to every single person that you talk to and simply ask them one question. What have they done to take care of their long-term care stay that's going to happen in the future? And then go from there. Thanks for listening. I hope that gives you a good amount of information today. And you got a question, feel free to ask.
Yeah, that's great, Chris. Thanks. Yeah, you know, we really beat the door down with long-term care around here at IAD, so everyone's real familiar with us speaking on it. But that's absolutely correct. And every single, again, most of you guys work in the senior market space, meaning for every 3 clients you have, it's like you said, 2 are going to run into this at some point in their life. So it's something you need to bring up with everybody. From that, we'll go to questions. Yes, Sal and Daniel, I'll get with both you guys after this to get you what you need. As far as customizable marketing materials and then underwriting for the LTC rider. We'll get to that after this meeting. But that brings us finally to just wrapping it up here, the funner stuff. So our marketing reimbursement program through Insurance Advisors Direct, which I'll show you guys. I'm sure you already got the notification. This is for the first quarter, but I'll explain this a little bit. Bernard, this is showing the template, isn't it?
Yes.
Okay. So the first quarter, let's make that clear. So we split up into annuities and life will include some hybrid options like what we were just talking about. So to start with life, since we're here, 20K in TP, what does that mean? 20K in target premium gets extra incentive dollars of $750. 50K in target premium, $2,000. 75K in target premium, $3,500. Just extra money coming to your business for doing what you're already doing. And then annuities, we have it split up pretty much the same. That's more straightforward as far as the premium that you've bringing in for the first quarter of the year. Now, there are some specifics with carriers when it comes to life, but again, I can answer those questions offline after we conclude our webinar. And from there, we'll have Bernard go ahead and go over the giveaways. And if anyone has any questions in general, please type them in chat. And we'll either review them at the end of this before we wrap it up, or I'll get with you after.
Yeah, so before we get to the giveaways, folks, I'm going to offer something as well. So Chris touched on long-term care, and we actually have a presentation for long-term care that's client friendly. And what I'm offering is and I'll run 2 virtual seminars for you. If you can get, a minimum of 5 folks on, I'll be glad to run that long-term care presentation for your clients. I'll do 2 of them, and then once you get acclimated with the actual presentation, go ahead and you'll be able to run the presentations yourself. And the reason I'm doing that is because we have actually a couple of agents that we've done that for, and they've been very successful. Tyler and I, we ran a couple of their virtual presentations for their clients. Got a bunch of, we have one agent from California that actually does very well doing that. So that's my offer to you. And Tyler will reach out to you offline more about that. Now, giveaways that we're going to do, and actually that can be one of the giveaway for everybody, the long-term care presentation. But what we're going to do is, so after we finish this webinar, Tyler and I, well, especially Tyler, he'll be calling everyone. But what we're going to do, we're going to put everybody's name in a hat that attended today. And for those folks, we're going to pull 5 names. And what those 5 folks will get, free business card design, free postcard design, and free car magnet design, all totaling with actually it's a $400 value that we will be giving away to the folks that attended today after we draw those five names. So here, I see we got Tyler, we have a couple of additional.
Yeah, I see it. And
yeah.
yes, well, the PowerPoint for long-term care, yes, we'll review that. We'll send you something for it, and then yeah, FIAs. And there is something tomorrow. I'm glad you brought that up, Arlene. Everyone who is on here, this was more life oriented. Okay, so this is more life hybrids, that side of the fence. Tomorrow will be the same type of structure with different speakers, different ideas, but it will be more towards the annuity realm. So, you know, both product lines kind of fall in the same court, but they're a little different from each other. So that's kind of why we did it on 2 separate days. So the big thing here to take away from today is, you know, it's a lot of information. A lot of you know this stuff already, but how to apply it. Bernard just gave you a great example. We will do these presentations for your clients if you get 5 or more together. Another one is simply, you all have clients are close with. Be on the lookout for qualified money that's been passed on or about to be passed on. And always, and I've said this before, a very, very simple way is just to ask for a life insurance review. You can go ahead and call your clients now. AEP is over, you know, the whole deal's over. You can call them, ask to review their life insurance. They're either going to say, I don't have life insurance, and that's a perfect door for you to open up and sell them life insurance. They may say, I work with somebody. Great. When's the last time you talked to him? That opens up that conversation. Or they'll say, sure, and they'll give you the statement. And then you just bring that stuff back to us and we'll help you through the case. It's so easy. It's just one question to ask people. And so that's how you apply these types of concepts. And after every case, you'll get better and better and better at this type of thing. And these off seasons where everybody just kind of lays low, you know, you'll have more and more and more income coming in. And those are just some ideas of how to apply these things. But yes, all these questions I will go ahead and answer for you folks offline, because they're all pretty conversational questions. So Bernard, anything else before we wrap it up?
Nope, that is it, my friend. I do apologize, had some technical difficulty in the beginning. For some reason, the slides that I had to introduce us, it kind of crashed the internet connection. I don't know what happened, but it did. So I'm not going to put that up there because I'm afraid that it might do that again. But folks, yeah, as Tyler said, join in tomorrow. Tomorrow is we'll be talking about annuities, and it's going to be a lot of great information. We're going to demystify the world of annuities. I mean, they're very simple. We're going to talk about a laddering strategy that you can use with your clients to offer multiple products. So yeah, join in again tomorrow, 10 a.m. Alan, I have to thank you again, my friend, for coming on and sharing your information.
My pleasure. My pleasure.
Yes, thank you, sir. So if that's it, Tyler, you want to close us out, my friend?
Yeah, that's it. So, hey, thanks guys for taking time out of your busy schedules for to expand your knowledge. And then in turn, this will, if you put it into practice, expand your book of business and revenue. So thank you for your time. We're here for you. You know, every case you guys get, if you're confused or a little nervous or just need some insight, we're here for you. Just call us. So you got a strong team back here with a lot of strong resources. So don't be afraid to get out there and start hunting cases down. And with that, we'll see you guys tomorrow.
Well, hold on. I think we have a hand that was raised. Constant, if you can hear us, type in your question, or let me see if we can. Yeah, type your question in here, and let's see if we can answer that. Or if not, Tyler's going to give you a call, and then you'll be able to answer that question as well, Constant. So no, thank you for joining in on us. But yeah. Tyler said, we'll see you folks tomorrow morning.
All right. Have a good day, everybody.
All right. Take care. Bye.